morning, everyone, and welcome to the European crossover webinar. And we've had, for once, we had quite a bit of news, and it's actually impacted the market. So we're going to spend a little more time focusing on the news because we had some key data and information that came across, and obviously the PMIs are going to be pretty key, but we're going to cover it across the board because it does set the tone and perspective. You can see, obviously, got some. And I screwed this down. These headlines are from 3 o'clock, but I had to pull it down here because they're not going to be showing up at the top. So the data is still coming in, but on this particular one under economic news, I had the PMIs. And you can see here, one of the key ones here is also this business expectations was the lowest since December, this last December. But we're going to go, we'll look at the charts, and I'm going to cover each of the news stories because they're key, because they do go in and change the perspective of what we're looking at, and also gives you an idea of what you're looking at going for the week ahead or next 10 days ahead. And as I told you before, that's kind of the way I like to go and trade is I'll use, base everything on the technicals, but I use the news to give us what's the underlying tone of the market. You can see the euro's on its low. So we're going to go into that, and we'll discuss that, but I'm going to go and be capping the news on that instead of just looking at these headlines and just hearing me yammer. So let's go and switch over to the euro dollar on the 2 hour. We're going to discuss what's going on here, and I'll go and cover the news. So, yesterday, the market was working up pretty good, and we were looking at potentially the market would go into this congestion zone, this 1030 to 1070, and everything looked pretty good. Of course, then we got which you already know about that. That's not the news, but I just want to put things in perspective. We got the jobless claims, which is the best jobless claims numbers, lowest jobless claims numbers we've seen in 42 years, which is pretty huge, obviously, and that took the wind out of the sails for the euro. But the resilience was right there because by the end of the day, here's the euro making its way back up, almost to the high up here, right around 10.15, which really here you had 10.13 was the 50%. We talked about once we got above 10. I was on an interview with Anthony Crudeli for Futures Radio. And I talked about that once the market if we got above this 10 area, that they were going to go on and sell with impunity. I was looking for a higher move in here, and it looked like the market was set up to go and do that. And even then, the market made a pretty good resilient move back above 10, and we're just holding up here. I was watching the Asian session. We're around 985, holding steady, so it looked like we take one more run in it. But of course, then we got the China PMIs, and then we got the Eurozone PMIs and some other things. So I'm going to cover those, and we'll jump around the charts just to give, once again, a perspective, because I think it's going to make a big difference overall. And we're going to push in the charts as we roll from one news story to the next, because I think that's what's giving us the big impact today, which overall the euro dollar is not doing too bad. It's on its lows, but I'm saying in light of the news, but the news was impacted here. Let's go on and go right here into the Australian dollar. And it says here that the Aussie hit 6-year lows. It goes on to say the Australian dollar sank to a 6-year low, and other currencies closely related to global commodities. Prices were under pressure on Thursday. Obviously, like that was at the very end. I mean, obviously we're rolling to Friday, but this was coming in around midnight. After the worst reading on sentiment in the Chinese manufacturing in more than a year. So the tone of this is obviously we're going to have that continued pressure on commodities, obviously gold, but we're talking about the industrial commodities like iron ore and also looking at copper. So this is probably going to continue to add further weakness for the Aussie dollar going forward. It was saying the euro and the yen and dollar in tight ranges. Eyes were on the yuan, the Chinese yuan. The Aussie often used as a liquid proxy for China trades fell to 72.69 in early European deals after the July survey of purchasing managers deepened worries over the health of the world's second largest economy. Slowing Chinese growth means less demand for commodities such as iron ore, one of Australia's chief exports. The recent decline in a wide range of commodities including oil has weighed on currencies like the Canadian dollar and Australian dollars. So as you know, the dollar CAD is still holding up really well. The dollar CAD looked like the dollar CAD looked like it was going to go in and correct some. But once we got the jobless claims numbers, the best jobless claims numbers in 42 years, then the dollar CAD was able to go on and reclaim the upward momentum. So it says the decline in commodity prices recently is still to be fully priced into the Aussie. If it isn't, then we think that RBA will deliver interest rate cuts. Something which isn't priced into the market. One market analyst was stating, pricing showed only a 50% chance of a quarter-point cut in Aussie interest rates over the coming months at a time when policymakers in New Zealand cut this weekend and signaled more was likely. The forecast for Aussie is to fall to 70 cents by the end of the year and by another 5% against the Kiwi. A slightly weaker PMI survey in Germany prodded 0.3% lower against the dollar, reaching 110 for the first time in more than a week on Thursday. That's obviously afterwards. Says Asian analysts have said there was some relief from the Greece taking another step towards a bailout, but the main trend of this week has been the halting of improvement on the dollar. They're talking about the Aussie dollar. Again, casting doubt on how fast the U.S. currency can rally further. But anyway, so here's the issue. Obviously, like I said, it looks like we're going to continue. We were talking about earlier in the week or over the last week, it looked like that we possibly might get in a bottom in here, a short-term bottom that allows to go and rally up towards the 75 and then probably go in and pull back. And the market did, it started us here with, on this being a 2-hour chart, a triple bottom here. We get a pretty good launch, and then we start to run out of gas. And obviously, the China PMI, when I was discussing with Anthony Crudele yesterday, he was asking, what do you think is the story going forward, Greece or China? And his Pipsar said it, and I noted also and credited him on that, which is, the Greece story, that's on the back burner. It's going to come back again, but no one's concerned about that right now. This is what's going on with China, which is probably going to weigh to a certain extent on the E-mini. I know I tweeted that out yesterday. Is once we got the jobless claims number, we got a rebound back in the SPOOs back up to about 2110, and I tweeted out on the way up. It was, I think it's at the time it was only trading like 2105. I was stating that, hey, look for the E-minis to go and pull back as they have to price in the risk of a interest rate hike. And so we rallied to 2109, we sold off pretty good to 2096, and we held there, and then eventually we went to that key pivot, the old 2092.75. We've since bounced off of that because probably you're going to see, once again, as I've indicated, is I don't see the Fed raising interest rates here in September. They'll probably do that afterwards, and in light of China being horribly weak, it's going to weigh somewhat on the U.S. as far as the Fed, and there's no way they're going to make a hike in September. I can guarantee that will not happen. So let's go in and move back in here into the euro, and we're going to cover some other stories, as I mentioned, that we're kind of setting the tone for what we're looking at going forward. We were saying here on the, says, take a look at this real quick for you. On the Eurozone PMI, it says Eurozone business activity started the second half on a less secure footing than expected, even with continued price cutting as the euro weakens failed to boost export demands, a survey showed. The PMIs, one of the earliest monthly economic indicators, could dampen hopes. The European Central Bank bond buying and the tumble in the euro are boosting growth and driving inflation. Now, we've got horrible PMI numbers that came across here. As I mentioned, the Business Expectations Index is the worst since 2014. So this is putting pressure on the euro. Not only is it because it's weak, but they see this as basically, as one of the story was saying, it's going to be pedal to the metal. It's going to be pedal to the metal here on QE. So that's going to continue going away here on the euro. And so, as I said, when you continue to see this weakness, surprisingly, it could have been a lot worse if you think about it. I mean, because from where we were in Asia, we were at 85, and we've only, here we are about 40 pips lower. But the PMIs overall were terrible. But I don't think there's a chance now that the U.S. is going to go and be cutting rates, not cutting rates, raising rates anytime soon. But this is going to continue to go and weigh on the dollar at this point. Not weigh on the dollar, but obviously weigh on the euro dollar. And as I was stating here, is on the PMIs, it was stating here that. But as they've seen since early 2012, firms cut prices, although only slightly this month. The output price index rose to 49.9 from June's 49.4, with input costs rising for a fifth month. It could move above 50 in August. Now, one of the things that they're looking at in light of these PMIs is a big focus is going to be on the inflation numbers that are coming in next week for the Eurozone. Obviously, if those inflation numbers come in weaker, that's just once again going to reinforce that pedal to the metal strategy for the ECB, and obviously the Fed in turn is going to be raising rates, two diverging paths. And we talked about, like I said, the safer route is, I mentioned that last week. I said, the thing is, if you sell the euro dollar, you're going to go and get if you short the euro dollar, you're going to get your money back. Okay, I mean, as far as your, profits or potential profits. You can't say the same thing about playing it from the long side. So when I've come in on the long side, I've been very careful, and I've waited for dips, and we'll come into a key area. And even then, when we come into a key area, I think it was yesterday, I was buying it at 960. Yeah, I went to buy at 960. I got filled at 962 or something like that. And we barely got up to like in the 70s, and I quickly jumped out because frankly I just don't trust it. The thing is, when you're in a down market here, when you're in an up market and you come into, and the market pulls back into a support level, you can just buy that support level. If you believe it's a good support level, as the market's pulling back, just buy into that level and the market pop. When you get in a down market, as we've been overall, when you come into this level, and which we did yesterday, then the market just kind of sits there for a while. Now, it did eventually pop back up, but I'm saying initially, I didn't like the way that the market, when we fell all the way down to 960, I'm thinking, oh, this is a great buy in here. And I stepped in and went long, and I think I told you, I think I ended up getting filled at 62 or something, but I didn't like the way it hung around there for so long, and I was happy just to get out with, a few pips on that scalp. But going forward for the next week, I think the euro is holding up relatively well in light of how bad the PMIs have come out, how terrible it looks for China. But we're going to have to be careful with this market. As I said before, the safer bet is just to go in and sell the euro. I believe that we're going to be. I know that capital economics is looking for a move towards parity by the end of the year. I don't know if we'll make it all the way down there, but my target is 102. So the thing is, just like I was saying before, and I was looking for these prices to go up, and I want to go and get short in here and I told you again, you can different ways you can trade this market. You can either just short it and hold for the long haul, or as we rally up here, sell into levels. I guess, and it's kind of mad. I should have taken this area right here because that 1013 has a 50%. And that's not necessarily a key fib like Pipsar likes to say, 61% and 38% of key, but you always get some action around a 50%. I just wasn't paying attention because, really, to be honest with you, I should have gone at least, as I told you, one guy was asking me yesterday, are you going to be shorting here? And I go, well, I'm going to be shorting here right up here in this 1030, but I'm going to be adding on the way up. And I probably, all honestly, I probably should have gone and taken this trade right here on the first initial run when we made it up here. And I wouldn't have hung on for this long, but I would have been happy to go and take that because you knew you were going to run into some turbulence, not turbulence, but some opposition here once you got up here at this 1013. I guess I wanted to squeeze just a little bit more into the 20s, and it stopped here. And the market was trading around here when they released the jobless claims number, and obviously it took the wind out of the sails. The market showed good resilience by being able, after that huge number, to come back above 10. I thought, okay, now they'll make a run, and I'm going to start selling it right in here. But the market started weakening again, and obviously the PMIs have weighed on that. But really, you're seeing across the board. And one of the stories that I'm going to say that I think is pretty key here. Take a look. This is coming across. It was also mentioned, and I don't know if I posted this story. Yeah, on the it's coming across the board. It's even hitting the emerging markets, and I'll go into that. It said most Asian currencies fell on Friday, extending their declines for the week as a disappointing survey on Chinese manufacturing activity added to the worries about a slowdown in the world's second largest economy. Regional currencies came under further pressure after China's cabinet said the country will widen two-way fluctuation in the yuan exchange rate to support its trade sector. One of the ones that got hit, the Indian rupee, hit a fresh 17-year low. The weak Chinese factor sector dampened commodity prices, adding concerns over sluggish exports of Southeast Asia's top economy. The Thai baht slid closer to a 6-year trough despite a central bank warning against its rapid fall. The currency was set to post its largest weekly loss in 2 years on capital outflows from the economy slowing, and the South Korean won turned weaker to hit a 3-year low at 1.168 per dollar, to suffer the longest weekly losing streak in 4 years. So the key thing is, and also reference this part, is activity in China's factory sector contracted at the fastest pace in 15 months in July, a preliminary private survey show, obviously the PMIs. The weak China PMI is increasing concerns about near-term growth in the region, which will continue to put pressure on Asian currencies, said Konggu, senior FX strategist for ANZ in Singapore, referring to the flash market China PMI. So you're going to see pressure across the board, and right now we got the euro dollar at 39. So you're going to see this. It's probably going to obviously going to be able to provide an underlying bid for the 10-year note overall, because I think this is going to go on and stop the Fed, the concerns in China, and the impact to global growth and how it impacts the U.S. economy. You don't want to sucker the punch the U.S. economy in September when multinationals are going to have a hard time being able to go on and make money, or their ability to go on export is going to be quite limited. So the last thing you want to do is throw in there an interest rate hike. So I don't see that happening in September in any way whatsoever. And at this point, I'm even questioning whether it could even happen in October. It will be coming unless, like I said, even if we start to see strong wage growth, I don't see them taking action in September. It would happen right afterwards. But if the wage growth stays steady and it's building up, they're going to wait a while in light of what's happening with China, because you're seeing global slowdown, and you're going to end up hurting the U.S. If you go in and raise rates too soon. So they're going to be ready, but I don't see that happening in any way whatsoever in September. This is a tone you're going to have to at least have this, for me, I would have this perspective or tone going out, because obviously the dollar is going to remain supportive. I don't know how much further the dollar CAD can go and push up here, but the technicals at this point, in light of the stories that we're getting now, would allow the dollar CAD probably to make another leg up, because no one's going to want to really sell the dollar with any force, and the way the dollar CAD is holding up here at these levels would allow for another leg up. So you have to go and be careful. We were set for yesterday. We were set for a pullback, and I was making the case that, hey, we're probably going to come down. We'll take out 29, probably come down to this 28.75, and everything looked hunky dory. Now, I did point out here that I think it was right here, 29.52. They stopped right on a dime at the 23%, but I was still looking for it to go and work lower. But when we got those jobless claims numbers, that really flipped the script. I mean, and so at this point, it will allow the market to work higher. But once again, you have to have this in the back of your mind, is that part of this is being priced in. Obviously, we've got crude oil's, has been terribly weak here. We're still trading at a $48 handle, and obviously gold's taken another whack on the backdrop of the Chinese numbers, but the dollar CAD hasn't moved any higher. On another run-up, they may want to sell into this because you have to look further out, and the idea is the Fed is not going to raise rates in September. And at the time, we were pricing in, okay, it looks like they got to price in that there's a chance and a possibility, not that I thought it would happen, for September. When you see what's happening in China, and it's the worst growth they've seen essentially in 18 months, that's going to cause the Fed to go on and pause. Like I said, the story says, China's the second largest economy in the world, and it affects growth in many areas. I'm saying is whether it's in Southeast Asia, Australia, Japan, impacts the Eurozone. This is not the time for the Fed to go on and raise rates. They're going to be on the cusp of raising rates, but it won't happen in September. So this is going to help the bond market. So you're going to see a very nice underlying big tone to the bond market. It's also going to probably stop the dollar from advancing much further. So you don't want to be necessarily sell the dollar hard, but I would think that you're going to run into some, technically we can make another run up here, but I would think that the market will slowly have to pull itself back in as they have to price in that chances are there won't be a hike in September. And with what's going on with China and the impact across the globe, because once again, there's the second largest economy in the world. So that's where we stand here with the Canadian dollar. I want to spend a little more time, as I said, focusing on the news, because I think it's going to have an impact when you're thinking about, hey, how much further can we go? No one wants to, we talked about this last week, when it's a Friday, nobody wants to get in the way of what's been the trend of the week. What 50 pips refers to is, Friday flows. Pretty much it's been steady dollar all the way, but no one's going to, at this point the market is set up for another move up. I just think that there may not be a whole lot when it makes this move up. We'll probably blow some stops here, but I would use that as an advantage probably to really tighten up your stops, because you have to think going forward, what's the chance that the Fed's going to go in and raise in September? Pretty much that drops very, very low in light of these Chinese PMI numbers and the implications for global growth and how that would affect U.S. manufacturers going on, U.S. multinationals. And that would be basically taking a sucker punch. Do we need to raise rates? Yeah, but we don't have to raise it in September. We can go on and wait a little bit longer. And I think on the backdrop of what's happening with China, I'm not sure how much if it pushes it out to December, but at this point now, at the very least, we wouldn't see anything happen until October. So it might allow the dollar to come back in a little bit, as people thought that September was back on the table. With the Chinese news, now it's not back on the table. So that's what we're here on dollar CAD. Here's dollar yen, and I've been scalping the short. And I actually did it yesterday, and I had covered, and I'm glad I did. When we were down here in the 80s and we haven't moved nothing on this dollar yen, I thought to myself, I don't like the way that it's been holding up here. I don't like it. And I don't think so much the dollar yen is strong, but one of the things here with, we were talking about that when we made this run up to 24.15, how we saw the good Japanese export numbers, and that allowed the market, the yen, to go and strengthen. But there were concerns about the implications for further growth because of China, which that's already come to fruition with the PMI reports out of China. So with the dollar yen being bid, I think it's more so as with China being so weak, there's that possibility that the BOJ may go and do some additional QE in September. Now, once again, I could see us work back up here in this area, and then once again, the dollar will probably come back in to go and allow for less likelihood that the Fed raises rates in September. But once again, I don't like the way that the dollar yen has been holding up so well, and I'm glad that past early morning I did not go on and short dollar yen. And really, it's been a whole bunch of nothing here because it's done nothing here. But with the technicals at the end of the week, I don't think anyone's going to go and fight, which is going to allow the market to work a little bit hard. I would think that anybody that's been playing the short side may even be starting to cover here. And I think that there's a chance we may make it back up here above this 24.25. We may run out of gas here, but I don't want to play in it right now. I'd probably do better or be more satisfied just trying to step in here and play the euro. I was looking for a bounce, but obviously those China numbers really took a whack. And but once again, I think that the dollar starting next week will probably have to go on and pull in a little bit because of the chances for a September rate hike are just not going to be in the mix. We're going to go and take a look over here at the Aussie dollar. As I said, the Chinese PMI really has done a number on Australia because, as I said, a lot of people look at that as a liquid proxy, as the article is stating, for China. And there's a good reason because the exports coming out of Australia, and one of the principal ones is iron ore. Well, China has had experiencing this big slowdown, then there's less likelihood that that's going to happen, as well as the possibility for copper, which ends up going away in here on the Australian dollar. They're saying they're looking for 70 cents by year end. This market, it's been, after this fall, it's done a whole bunch of nothing and looked like it was trying to base. And even here, it looked like it might be able to base, but it's going to be hard for this market to go anywhere. And I'm thinking it's going to stay pretty quiet with a little bit of a downside bias here. Can't get anyone really to want to pick up this market, but it's so low that it's probably just going to drip a little bit lower, and you probably see something like around here. The market's just trading a 100, 150 pip range over the course of a week, and not really a whole lot happening. So we're going to go and take a break now. It's time to go and catch a break. We're going to come here with the cable, and we talked about this market eventually pulling back in here into this lower area. And we've come down in here, so we're going to take a break, and we'll just look at the technical picture on this. So let's go and take a quick break. So everybody, welcome back to the European crossover webinar. And we're looking at the cable. We're going to move into the gold, but we were looking at this yesterday. I was talking about covering in here at the 54.68 area. We had the support here at 63. As I've indicated to y'all, I don't trade the cable. I do keep an eye on it. It's just not a pair that I like to trade. You can see here where the market just stayed quiet for the longest of time, but I was talking about this covered in here at 68. We did make it down here to 63. But like I said, we'll see what, and we can go and take a look at a real quick fib on this, but I want to go and move into the gold. This 54.63 area is pretty key, so I wouldn't look to get much beyond that. That actually turns into be the 61% right here. You can see this here, 61% of this move, and came into 54.63 level. You can see the significance of this level right here. And this is what I'm saying is look to, 54.68. I think it was 54.68 that I mentioned as an area to go and cover. But let's go and move into the gold, and certainly that got whacked and has been impacted by the Chinese news. And let's go and switch into that. Now we've held this area here, and I mentioned that if you look on the 30-minute chart, this 1085 area. And the market had come off of that, and let's go on and mark this off. I mentioned that yesterday. You know, on the move down here to 1080, and we had rallied back up here at 1107. We came back to find support here at the 1085. And this is where the market had come back down to retest. We had talked about the 1095, and the market gotten below that. Hadn't gotten much further beyond 1095. But as we started to work lower, we found that support on Wednesday at this 1085, right in here, and the market started basically just some short covering here, started working higher, got up here to 1105. And we'll come back here and we're challenging this level. But once we started coming with this China PMI, that really did go and take the stuffing out of this market and really took it for another loss. Because like I said, with China, then on top of that, with China slowing down, and we've seen the worst numbers, I think, like I said, is in 16 months on the China PMI, and the implication for global commodities, of course, obviously industrial commodities like iron ore, and that's the reason why the Aussie dollar made new lows, and there's concerns, obviously, for Japan that does a lot of the exporting to China, and the potential that Japan, the BOJ, may be doing further QE come September. That was just as soon as, 36 hours ago, that was being pushed back to 2016. Now with these horrible China numbers, that probably puts the BOJ potential for additional QE in September back to the forefront, and you can see here the dollar yen has maintained its bid overall. But this certainly did go and impact the gold market, and this area right in here, this 1085, that's your resistance now, and the market's just going to have a tough time. It'll probably try and see if you can go on and find some covering down here once we come back to these lows, but it looks like, once again, it looks like from an overall perspective, we're eventually going to be heading towards $1,000. As I said, I was looking from last week for year in, the first quarter of 2016, although on the way down, I thought that we would be able to hold 1137, and of course that last Friday we were hanging on to these lows here at 1130, but then of course that reported selling by China really knocked the market and took everything out of it for 50 bucks here, and since then it's just been bad news. And then I was seeing a good story here. I don't remember what I was reading that from. I think it was Bloomberg, about, actually I saw it on Bloomberg, all the commodity funds, a lot of funds were pulling out of commodities, and that was continuing to go on and weigh on it even further. People aren't going to come, you'll see minor bounces, but once you get a big movement like that, you're not going to be able to turn around anytime soon. You're just going to get pauses. And we continue to see the weakness in crude oil, and it's just been amazing how this has gotten shellacked. And once we lost that 50.17, which the market was trying to hold that 50.17, but once it got past that, we talked about a move to $48, and I said, if we lose that, and even if the market gets down to 49.34, I think it's at 49.40, I go sell it, because it's kind of reminiscent of what I was saying about the euro. You'll get your money back. And the market tried to stabilize, but here we are going to the $48 level. And so we've been as low as, 48.19. So, like I said, when you got, if we were to lose that level, I said if we get down into the 49.40s, just short it, because you're going to get your money back within 24 hours. Well, it took a little bit longer than 24 hours, but not much. And we've come as low as 48.19. So even if you sold it there, you'd have been up with about $1.50 or $1.40. The market's just real tired now, but what can you do here? This market, we've got so much supply, and it's funny because when we were up here, I was arguing the point of all the frackers and how when we made this move up here into the 60s, as we move it up here towards 60, I go, that's just going to bring the frackers back. But nobody cared about that. And I was yammering about the frackers for so long up in here, and all I kept hearing was, we're going to $70. And I just didn't see it. There was no way in heck I said we're going to go and do that. And it just goes to show you is that, and I mentioned that yesterday, is that when you'll see a story develop like the one about China. And I went on about China, about, it was so, the levels of the market were so high, and you saw all these people coming into the market, opening up at one point up to 3 million new accounts, a week, but nobody cared. And then eventually the story became what it was. Well, no one cared about the frackers up here. All I kept hearing was $70, $70, $70, and then all of a sudden the bottom fell out. And it just goes to show you that when these people bail out, or these funds bail out, then it's just run for cover, because once they start to bail out, the momentum of that happening, it just feeds on itself. So even when you come into areas of value, they'll only work as a pause, and then the market just wants to go lower. It kind of reminds me of what we saw on the way up. And I remember when we came into, I have to pull up on a 4-hour chart, when we came into this level up here, I think it was right in here, I think it was right here, the 4880 area, when we was out here around the 50, and the market didn't care. Once it knew it, everybody started piling in. The market didn't care when it came up to these levels. I mean, $54 was huge, and it did back down, but then the market just went right through it like nothing. Because once again, like I said, once this momentum gets going, there's no stopping it. Well, it happens, obviously the momentum works both ways, because once we lost this zone here, the 60.66 to 61.22, that was it. And I've already gone on so many times about it was this bar that did it right here. And I try to be hearing it, but this is when it came out with pips are. And it's not a matter of trying to give myself some back slaps. It's just that this was so critical to me, because we had spent so much time trading in this red zone, and then we finally got this positive bar, which is the first positive bar we got on an upward move, and then the market quickly gave it back, and then we got this long-legged doji right in here. And that's what I'm saying. That's it. That's it for crude. You won't see it. It wasn't so much a big technical call. It's just that the market had been fooled so many times through this zone. You can see that. It had been fooled so many times through this zone that I said, that's it. That's it. People are going to give up on the market. Obviously, there was more to it, and there was no way. I thought worst case scenario would have been $54, and then we could have seen a bounce. But as people started to exit here, and you saw funds getting out of commodities in general, then it's the momentum that's weighed on this. And you're seeing the same thing here in the gold market. But with the gold market, there's something also behind it, because of those horrible China PMI numbers that's gone and weighed even more, and actually taking gold for a new leg lower on the backdrop of the China PMI numbers that we got last night. So moving back in here in the S&Ps, yesterday we got those fantastic jobless claims numbers, the lowest jobless claims numbers in 42 years. So when I think we were trading around 04, 05, and I said, hey, look, the S&Ps are going to have to work lower over the next couple of days to factor in the possibility of September rate hike. And we actually moved higher towards this 10, but lo and behold, we came down here to the 96.50, and we did go on the fall. So that was really a relatively easy short. That was a good, you're able to go in and catch yourself a good 13 handles. When we rebounded from that, we rebounded on the good news, but I said you're going to have to factor that in, that the possibility of the September rate hike. And that was a pretty good move, and I'm just talking all the way just down to 96.50. Forget the pivot that we came back and we've rallied now. Now that being said, on the backdrop of these China numbers, there's no way that the Fed's going to go and be able to go in and raise in September. And I was mentioned earlier in the show that why I expect now you're going to go and have a pretty good undertone bid to the bond market, or the notes. Notes in particular is what we're looking at here, because there's no way the Fed's going to be able to raise in September. The Fed's going to go with whatever is going on here in the U.S. That being said, they can't ignore the horrible numbers in China, the worst numbers that we've seen in 16 months, and the implications for that it has for U.S. multinationals and even the U.S. economy in general when the second largest economy basically goes into the toilet. Okay, and obviously that has octopus arms going further out, or tentacles, I should say, to growth, for Japan, which now kind of flips it, where there's a potential that there could be, they have to price that in, potential for QE, additional QE in September. Obviously, that's going to weigh in on Eurozone growth, and so there's no way the Fed's going to go on and raise in September. So that's going to have to be factored in. That'll probably allow the SPUs to hold up in this area, but it's going to provide an underlying tone bid here for the bonds or credit markets, in my opinion. Let's see how much time we got. We still have time, good time. So going back here to the SPUs, we got that dip on the idea of that the Fed's got a potential for the Fed to hike. But we come back here, I think we're going to be doing a whole bunch of nothing. The economic numbers haven't come in so great either, so you're going to get that, the bid here, the market's holding up really well, where the Fed's probably not going to have to be able to do anything in September. That being said, you can't ignore the bad numbers that we've been getting out of some of the companies. So I think that eventually we'll have to go in and work lower. My guess is that over the next week or so, we'll probably have to make a move down here towards 84. Is probably, we'll probably work, the way the market's been, and it's put new money to work every Monday, we'll probably vacillate right in here between 2101 and 2110. But also the China data is going to really weigh, because you have to go in and look for global growth, and that's going to go on away. So I do expect us to go on and move down here to this 2084, 2080 area. That China, even though it looks like the Fed won't be able to raise, there's going to be that concern for growth going further out, and that's going to impact growth estimates or EPS. Once again, even though you got the money coming in, I think you're going to go on and see this market have to go on and pull back. My guess is you'll probably pull back to something like a 50%. So if we look at it from a fib level, that takes us here to 2080. And this is what I think we'll go to. We can vacillate around in here, but I think that we're going to have to come back down. We'll come back down to 2080. I don't know if it may be as early as next week, but when you look at the implications for these horrible China numbers, you have to figure that at this level, you have to think that the SPUs will go and come in. Once again, Mondays are always usually generally a good strong period, but I think that going into Monday, if you see anything making a move up here above 2110, at that point I have to say that's a pretty decent area from a risk reward perspective to get short this market, looking for a move down here to 2080. You could just go on and wait till Monday and see if we can get some of that, put new money to work Monday. But any moves up here, I think on a risk reward perspective, and on Monday, if you want to go and take the risk ahead of that, if we get a bounce up here, but I think going forward into concerns with China, that should go on and give us a move down here to 2080, which is pretty key. You can see how this was capping the highs up here at the time, and that also happens to be a 50% of the recent range. So I think that's where we'll be going over the next week to 10 days here in the SPUs. Crude oil, as I said before, 48 is pretty key. This is what they're looking at, but I'll tell you what, right now, with us losing this area here and the amount of supply that's coming online, it looks like we're going to go down there to 44.70. We'll probably get a little bit of a bounce, maybe not much of a bounce. Maybe we can touch 50 and get a little bit above it, but it looks like we're going to be heading towards that 44.70. And you have to figure also, once again, China weighs on that, because if China's in that bad a shape, which they are, that's going to affect Eurozone growth, growth out of Asia, and I'm talking about the ability to export to China. We're seeing new lows here. I mentioned that earlier in the show on the Thai baht, the Indian rupee. I think the Indian rupee, I think it said, what was it, like 17-year lows, I think it was, the Thai baht, and also there was the Korean won also. So if you're seeing that slowness, there's going to be less demand or less need, I should say less need for crude oil. That's just going to go way on. So it looks like we're going to be going down to that $44 in the crude oil market. We may see a little bounce from here, but it looks like that's going to be pretty much a done deal. And once again, to come back in here is why I believe that you're going to see a nice underlying tone, big tone here for the credit markets here because of that slow growth, the implications for us there. So let's jump back in here. We can come back in here to the FX. Overall, the euro is holding up better than what you would think in a lot of the horrible PMIs. That being said, the jobless claims numbers really flipped the script on this thing. The euro looked like it was heading up here for this 1036 area, and we could see a nice little fake out. One of the things that you're going to have to take into consideration is, and I'm talking about for next week, is the chance that the Fed's not going to be able to go on and raise rates in September. There's no way they can raise rates in September. I don't care if we even have big wage growth. They're going to go on and wait beyond September. There's no way they're going to raise on the backdrop of the world's second largest economy going into the crapper. It's not going to go and happen. So we might go and see the market try and make another challenge up here. But yesterday, I was even surprised at the resilience of the euro. We made it up here to this 10.15. I was waiting to start shorting in here. I should have gone and shorted here because the 50% isn't a big key number, but you always see some resistance when you come into a 50%. But of course, like I said, we were here when we were trading right on the release of the jobless claims. That really took a big whack, and the euro showed resilience, getting back above 10. And then in Asia, we were trading at 9.85. So we haven't come off that bad, but it's going to be tough for the euro to get back. That being said, at the beginning of next week, I would look for the dollar to go on, and no one's going to fight this thing at the end of the week, but going into next week, by Tuesday, I would expect to see the dollar start to ease off a bit. That may allow the euro to kind of make another move back up here towards 10, but once again, people are going to go and short that thing with impunity. So I would be careful trying to sell it here. I'd rather come back in and let the market see if by Tuesday, Wednesday, we can't go on and get this thing moving up back towards 110, and then you can just start to pick your places where to short this thing for the long haul. That being said, like I said, do expect the dollar to pull back a little bit because there's not going to be no chance that we're going to raise rates in September. So maybe we can run here, but once again, I think people are going to sell this thing with impunity. So the thought is, even if it comes up here to 1030, 1040, nobody's going to care. You could put 75 pips in people's grill right up their face, and they're not going to care because they know that by the end of the year we're going to be close to parity. As I said earlier in the show, capital economics is looking for parity by year end. I don't know if we'll make it all the way to parity, but I do expect us to make it down to 102. So once again, no one's going to be worried about any 50, 75, 85 pip moves. If they get an 85 pip move in their grill being short the euro, nobody's going to care because you know you're going to get your money back. And we talked about that last week. So we'll also go back up here at the dollar CAD. Dollar CAD looked like it was set where you could go in and see, potentially a nice a little bit of a pullback. And we came right here, right to the 23% of this move. And then, of course, we got the jobless claims numbers. Now, once again, no one's going to go in and fight this on a Friday. And obviously, this shouldn't, because we've got the technicals here now. 3065, which we haven't hit here, is that key weekly level. And I could see the way it's set up technically, let this sucker rip. But once again, I think by Monday, early Tuesday, I would expect the dollar to come back in a little bit because there's no chance that they're going to be able to go and raise rates. I'm going to keep singing that song because the way I like to trade them is I like to look at it from an overall, even though I'm a day trader or scalp, I like to look at what's the overall perspective of the market. Like I said, on Fridays, as 50 pips likes to say, get the Friday flows. It's not as much of an impact this time because it's just all been pretty much one direction. There hasn't been a give back where people are trying to trade it the other way. But no one was it said last Friday. No one's going to go and stand in the way of a trending market on a Friday. If you want to take the other side, I'm not talking about dollar CAD. I'd be saying something like with euro or dollar yen. You're going to wait till the next week. You come in because you can come in fresh. You don't have to worry about what could develop over the weekend. We'll probably see a continuation of these trends as we come into next week, the first part of the week. But then I think that you'll start to see the dollar wane a little bit on the idea that there's no way that the Fed can go on and raise rates in September. So let's see how we're standing here for time. Blake should be coming here.